FIFO, it is such a cool accounting tool that we can use to calculate things like closing inventory and cost of goods sold. All right, and that's what we're going to learn about in today's video. Right, it's an assumption that we use in companies to value their inventory. Okay, so it means first in, first out. So if we looked at an example of a milk company, for example, all right, the milk that they purchased first, it is the milk that is in first, they will sell first. It makes sense. I mean, if they put it on their shelves, they don't want it to go bad, right? So the milk that they purchase first, and they want to sell first to their customers. And we're going to be continuing on this example, all right? And we're going to be going deeper into this example, right? So let's say, for instance, that this company has been going on for quite a while, all right? And I'm going to draw a little bit of a table here. And let's say they had opening stock, opening inventory, right? Opening inventory, all right? And let's say that they had about, let's say about 1,000 units, 1,000, okay? And we're going to call this the units column, okay? And then we can also need the price per unit, which I'm going to say is PPU. And then we're going to have the total cost. All right, and this can just help us find what is happening in the situation, right? So the opening inventory was 1,000, all right? And let's say it was $1 per each of those 1,000 units, okay? So the total cost would obviously be just $1,000, okay? But then the company says, hey, we're gonna be selling more this new month, so we need to purchase some more. So let's say it is the month of April, and it's today, so the 4th of April, right? The 4th of April, 2022. This company's gonna purchase some more milk. They're gonna purchase 1,000 more units, okay? And they're gonna purchase it for around $10. For $1, okay? And so the total cost is about 1,000 again, all right? And then let's say the 18th comes along and the prices have increased because of inflation and oil prices increases. So the price per unit is actually doubled. It's now $2. And so they can only afford to buy 500 units. Okay, and those 500 units, well, the total cost we know would still be 1,000, even though they had less units, right? And so again, they want to buy even some more, okay, because they think they're going to sell some more in the next month, and they worry that next month the prices will increase even more, so they want to purchase more now. So again, they purchase another 500 units, but now it's $3. So the total cost comes to $1,500. Okay, so now we want to know, what is the closing inventory, right? The closing inventory. Now, in order to work out the closing inventory, we need to know how much did they sell. That there is very important. How much did they sell? Well, let's say they sold 2,000 units in total for that month. All right. Now, under the assumption of FIFO, I'm gonna move this down a little bit so we can see what's going on. So under the assumption of FIFO, we're saying that first in, first out. So of that 2,000 units, we can split it up into 1,000 and 1,000. All right. And so that 1,000 is going to be at the cost of $1, and this 1,000 is going to be the cost of that $1. But this is coming from the opening inventory, and this is coming from the purchase on the 4th of May, 2022. All right, and that there is very important. But let's say they sold 2,500 units. All right, and so maybe this was 2,500. All right, then we know another 500 units was sold, but then that would come from the 18th of May, which would be at $2. All right, and this is cost. It's not selling, right? This is just all about the cost to the company. Okay, but that's not going to be our example, but you can see where we're going with it, right? Because the first in is the first out. You can see how these two were untouched because we bought them at a later date, okay? And there is this thing called last in, first out, which is a complete different set, and you can kind of imagine what the story would be there, right? So the cost of what was sold, you can imagine, was $2,000. And so you can say to yourself, well, cost of goods sold is 2,000, so that would be my cost of sales, all right, which is equal to your cost of sales, all right? This would be your cost of sales, abbreviated to COS, right? So that would be your cost of sales. But the problem is, well, it's not a problem, but we can actually find it in another way by using the closing inventory. You see, the closing inventory, well, we know that would be, since we sold the first two, the last two would be what was left over. So we can say, okay, so on the 18th of May to 2022 and on the 29th of May 2022, all right. And we know the cost of that to the company was $2 and $3, okay? And we know the units was 500 and 500. So we can say, okay, well, the total inventory left on hand would be a cost of 2,500. So inventory on hand, all right, after the month ended would have a total cost of about 2,500, all right, and it would be 1,000 units. And you can see how inflation affected the inventory, right? It's the same number of units, but you can see how the cost was now much higher. Okay, so that's just something different. That's cool for general knowledge, right? So now I said that we could use this to find our cost of sales. And so if we now just get rid of our milk bottles here on the left that looked very nice, we could then do something quite special. We could say that we could have the opening, right? We could have the opening, and then we could say, well, we have purchases, all right, that we purchased during the month. And then we could say closing. And this here is somehow going to equate to our cost of sales, all right? Now, our opening we know was a cost of about $1,000. The purchases we know totaled about $3,500, okay? And then the closing, we're going to minus, all right? We're going to subtract the closing, because if you think about it, the closing is not what's sold, okay? You see, cost of sales is stuff that is sold, okay? And so anything that is, in the closing bracket means that it was not sold. So we have to minus the cost of that. And the cost of everything we know that was not sold was 2,500. So we're going to subtract that. And so we're going to get a final value here. And that is going to be our final value for cost of sales. So $4,500 from the sum of these two minus $2,500 gives us a cost of sales of how much? $2,000, which we equated from over there. Of course, this is again the FIFO method, and you can actually use this in other methods because it basically always works out. But in the FIFO method is quite good because we are under this assumption, right? I really hope this helped. It's Curated. Hope you have a great day. Stay happy, stay healthy.